Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, September 30th, 2020, and I am pre-recording this Trading Places Live for Thursday, October 1st. Futures are currently higher, poised to extend gains that we've seen earlier this week. Also, history tells us that the first calendar day of the month is the best calendar day of the month. Since 1950 on the S&P 500, the first calendar days of the month have produced annualized gains of plus 46.02%, which is more than 5 times the average annual return on the S&P 500 of 9%. So clearly, there's a tremendous bullish bias to the first day of the month. In addition to the higher annualized returns, the frequency of the S&P 500 moving higher on the first is higher than any other calendar day. More than 61% of the first calendar days of the month have moved higher, and that compares to just 53.5% of all trading days moving higher since 1950. So there's definitely a bullish bias to the first day of the calendar month. They don't always go up, but the historical tendency tells us to prepare for higher prices, and so far, futures are pointing to that. As far as today's agenda, I'm going to go through and give you the daily market recap. I will go into talking technically. I want to show you some relative charts that I like to use versus the S&P 500 and how I do that. We'll do that during talking technically. I'm going to get into a quarter three recap. We did just finish out the third quarter, so I want to talk about a couple things that occurred in quarter three. And then maybe look ahead to quarter four in terms of an outlook. I just did a pretty intensive outlook webinar for our members over at Earnings Beats. Went into a lot of different areas, so this will just be a little bit of a recap, minor recap of that. And then take a look at just a couple of companies during the earnings spotlight, companies that will be reporting on Thursday morning. And we'll wrap up the show with 3 you must see. But before I get into all of that, I want to point you all to earningsbeats.com. Make sure, if you haven't already, subscribe to the free Earnings Beats Digest newsletter. I publish this Mondays, Wednesdays, and Fridays, and normally focus on earnings, relative strength, and the sort. All you have to do is type in your name, email address, hit that subscribe button. Be happy to get you started there. Really some great information. Also a lot of short squeeze stocks we feature on there. So I think you can get a lot of really good information from that newsletter. Again, 100% free, no credit card required, and you can unsubscribe at any time. Looking at our portfolios, we do keep our portfolios up to date every day at the end of the market day. And you can see now that our model portfolio, which started less than 2 years ago, is now up 150%, higher, more than 150% in just over 22 months. The S&P 500 during the same time frame, not bad, up 25%, but the model portfolio is up more than 6 times the S&P 500. I think that's pretty remarkable. This quarter alone, which started on August 19th, so we're talking about, not even halfway through the quarter yet, the model portfolio up 10.3%, S&P 500 down 0.35%. That's some serious outperformance. So unless things change, we will outperform, the model portfolio will outperform the S&P 500 for the 7th quarter out of the 8 since its inception back in November of 2018. The other portfolios have done very well also. Aggressive portfolio, you can see there since inception, more than 25 percentage points above the S&P 500 return over the same period. Income portfolio is down a little bit. We did have one rough quarter back during the pandemic from February through May. That portfolio was hit pretty hard. But other than that, the income portfolio has outperformed. It is outperforming this quarter slightly by about 1.6 percentage points. And then the strong AD portfolio, which is the strong accumulation distribution portfolio. Stocks in this portfolio are based off of that accumulation distribution indicator. And we attempt to put together 10 strong equal weighted stocks in 10 different industry groups. that show strong accumulation distribution lines. And you can see this portfolio, since its inception, up 29.5%, almost double that of the S&P 500. So a lot of good action there. If you want to check out our portfolios, you want to check out our service, we do have a fully refundable $7 30-day trial, and you can start yours by clicking on that Join Today button. All right, let's take a look at what happened on Wednesday, our daily market recap. The Dow Jones finished up 329 points, the S&P up 27.5, the NASDAQ up 82. Mid caps finished higher by 12.5 points, small caps up 2 points. Everything up mostly less than 1%, although the Dow did finish up a little more than 1%. And the Dow was up over 500 points earlier in the day. So we saw some afternoon selling, but overall, we have climbed back up now above key moving averages. The Dow Jones has cleared both its 50 and 20-day. S&P 500 has done the same. So too has the NASDAQ. And we're still waiting for mid caps to get back through that 50-day, but we did barely clear the 20-day EMA, so that was a start. And the laggard, small caps, still unable to get above either of its key moving averages, but I do suspect that will happen here in the fourth quarter as we move forward. On Wednesday, from a sector perspective, you can see that the healthcare group was the leading sector, up 1.6%. Financials, which have really struggled on both an absolute and relative basis, did climb 1.35%. And I will say this, financials during this bull market, I was surprised when I looked this up. Financials during this bull market since 2009 have outperformed by at least 1% above the S&P 500 on average each of the next 3 months, October, November, and December. And what I find really interesting about that is throughout the bull market, none of the first 9 months show any outperformance by financials. So January through September, every single calendar month, average returns on the financial group have been less than the S&P. But when you get to October, November, and December for the last 11 years, financials have their average returns are 1% or more above the S&P 500. So even though financials have been weak, we are entering into a historical period that has been very bullish for this group. It's going to be interesting to see whether or not financials start to make a move. It's probably going to depend a little bit on the 10-year Treasury yield. If the yield moves higher, I think it's going to, then I would expect financials maybe to surprise some folks and have a pretty good fourth quarter. Staples up more than 1.2%. Materials up about 1%. Utilities up just under 1%. Those were your leaders. And when I look across the board here at the leaders on Wednesday, where is technology? Where is consumer discretionary? Where is communication services? None of them to be found here. They were, they were performing okay, but they were not leaders on Wednesday. One day doesn't make a trend, but I thought it was noteworthy that the market had a strong day, and yet we didn't see any leadership from those three areas. All right, let's move on to the 10-year Treasury yield. Looking ahead to Thursday, we do have a number of economic reports due out. Initial jobless claims estimated to be 850,000. That'll be out at 8:30 in the morning. Last week, 870,000 initial jobless claims. So we're looking for that number to come down a bit. August personal income. This is kind of interesting. We're looking for personal income to drop 2.5%. July rose 0.4%, and the estimates, the consensus, was all over the place. So the range that we were looking at on the August personal income was anywhere from about -3% to actually in positive territory, but the average came in at -2.5%. I'd be surprised if it was that weak in August. I don't really understand why it would drop 2.5%. But anyway, that's the number. August personal spending is expected to rise 0.8%. July rose 1.9%. So we're looking for that to come down a little bit. September PMI manufacturing and September ISM manufacturing both due out, both looking to move slightly higher than the August numbers. September PMI was 53.1 in August. we're looking for 53.5 in September. And the ISM manufacturing number was 56 in August, and we're looking for 56.3 in September. And then finally, August construction spending. I don't really follow this one very closely because it is a report that comes out way in the rearview mirror. The July number had come in at an increase of 0.1%. That's expected to jump to 0.7% in August. All right, let's move on to talking technically. And what I've done here for talking technically, the top part of this chart, this is a 30-minute, each one of these candlesticks is 30 minutes. So it's an intraday chart, 30 minutes, that goes back roughly about 3 weeks. And so here's your S&P 500 taking us back to about the 10th of September, all the way through the end of the month. We're essentially right about where we started the month. But the thing that I thought was interesting here is that we went down and we set a low on the 21st, and then we put in another low that was slightly lower on the 24th, beginning of the 24th. Now, a couple things about this. Number one, historically, if you follow my work, you know that the 19th to the 25th tends to be the worst time of the calendar month. And notice we set a low on the 21st, and on the 24th, we have another low. Beginning of the 25th, we were down close to those lows, and then we start rallying. So almost like clockwork here in September, we saw the weakness heading into that 19th to 25th period. We get through the 19th to 25th period, and it's like magic. All of a sudden, we start trending higher again. That's point number one. Point number two, take a look at the lows. You know, as we were going down, I've got some relative charts. XLY versus XLP, discretionary versus staples, going lower. IWF versus IWD. This is growth versus value, going lower. XLK versus the S&P 500. This is technology, relative weakness throughout the initial low. Consumer discretionary. You can see the weakness to that initial low. And then communication services on a relative basis, downtrending into that first low. But the interesting part is the S&P actually printed a new low 3 days later. But what were these ratios doing? They were rising. This one was rising. This one's rising. This one was rising. This one's rising. And that one is rising. So while the market set that initial low on September 21st, everything in the market was kind of bearish. All the ratios, some of the key ratios that I follow, were all pointing down as well. But when we put in the second low, a lower low, things had changed. And then we saw the market rebound. It's this below the surface information that we have to be able to process as traders and investors to set ourselves up for the best possible outcomes in terms of trading and investing. And these are just little subtle hints that the market gives us. And if you know how to use these hints and you know how to chart and follow these different charts, this is an intraday chart that I use pretty often, looking at the S&P versus these various ratios. And so as we've moved up, you can see the ratios also, for the most part, moving back up as well. The one exception I would say is communication services. This is a group relative to the S&P 500 that is trying to break out above a 2.5-year base and consolidation. So communication services is a group that has an opportunity to really help drive the market higher in the fourth quarter, and is one that I'm going to be watching very closely. But so far, at least through Wednesday's close, not really giving us that bullish, all engines firing at this point. Got some engines firing, just not all of them. We'll have to see whether or not we can get the communication services going. All right, let's move on. I want to talk about the third quarter and maybe look at a little recap here. So as I look back at the third quarter, first of all, the S&P 500 gained 8.5% roughly in the third quarter. And so when I look at the chart, what I did here is I've provided 5 industry groups that I believe are 5 of the strongest industry groups as we head into the fourth quarter, based on how they performed in the third quarter. And where I got these from is I have a relative strength industry group chart list that I use and offer up to all of our annual members at Earnings Beats. So you can download this entire chart list into your account if you're an annual member at Earnings Beats. And what this does is it just quickly summarizes for me over different time frames. I can change this. So I've got it set for 3 months because I'm looking back at this past quarter. So I want to see how these various groups did in the third quarter. And I've got all of them set up relative to the S&P 500. So for instance, when I look at the automobile chart, if I go to the bottom, I can see the absolute chart on automobiles, and you can see the automobile index just soaring. But the top part here is what the summary lists are based off of, and this is a relative chart. This is the autos relative to the S&P 500. And if you want to try to beat the S&P 500, you want to be in areas that are beating the S&P 500. So in this case, automobiles. You got the autos on a relative basis been going straight up. We've had Tesla in our portfolios the last couple of quarters. It's been a great performer. We have NIO, NIO in one of our portfolios as well this quarter, and they have been great performers as a result of this strength. Because again, if you want to beat the S&P 500, you've got to be in stocks, leading stocks in areas that are outperforming the S&P 500. Autos, definitely one of those groups. Delivery services is another. And it's got this based on a percentage change. So you're looking at the percentage that automobiles have outperformed the S&P 500. Same for delivery services. So this gives us the best performers. Now, the ones that I put on this chart over here are not exactly the top 5. I didn't include the paper index. And the reason being, yes, we had a strong quarter on a relative basis. But look at the chart. I mean, on an absolute basis, paper index was at 195 20 months ago. Now it's at 110. Yeah, we had a short-term move to the upside. Relative strength certainly improved in the last quarter, but we've still got a relative PPO below the center line, and we still have relative price numbers that are below the 50-week moving average. This isn't a group that I'm interested in. It's an improving group. I acknowledge that over the past 3 months, but this is not a leading group, so I ignore it. And as you go through, you know, you've got autos, delivery services. Let me show you this. There's delivery services. We're talking about FedEx, UPS, Atlas Worldwide, which is AAWW, those types of companies. Renewable energy has been on fire. You can see. Do you see the difference between this and the paper group? I mean, paper has shown only 3 months worth of strength. We're seeing a lot more than that from these other groups. So autos, delivery services, renewable energy, home construction is the 4th one I included. Look at the strength there, breaking out. Low interest rates certainly contributing to this. And the last one was footwear. And footwear, after sideways consolidating for close to 2 years, we finally got the breakout. Look at the relative PPO. Look at the absolute price action. Footwear looks very strong heading into the 4th quarter. So as I, look and see what, has been leading the market, these are areas of the market that I want to at least be considering as we go into the 4th quarter, because Wall Street's betting on these companies as we head into earnings season. So that's what you want to look for. Now, some of these others, paper index was one I didn't include. Here's coal. Take a look at coal. I mean, this thing has been going down on a relative basis now for over 2 years. This is what we got, a nice little pop for about a month. It was great, but it's a dead cat relative bounce. Look at the relative PPO, still at minus 18. That is awful. Short term, we're getting a pop. Long term, I want no parts of this group. And then the other one, this one actually is strong. Non-ferrous metals. I just don't know, and this is one of the things I talked about with our Earnings Beats members during the Q4 Market Outlook webinar that we just hosted. This is a good looking group, but materials itself, I'm just not quite convinced based on the dollar and which way the dollar is going. So it's a group that I would not feel, if I'm trying to name my top 5 groups or 5 of my top groups going into the fourth quarter, I just can't put this one in there. Yes, the last 6 months have been pretty strong through the pandemic, but if materials begin to weaken, it's going to be tough to keep this strength going. So that's why I avoided this one. All right, let's move on to the quarter 4 outlook. And, when I looked at the fourth quarter, first thing, and this is a chart that I love to go through. This is my big picture. I'm a fairly short-term trader, but I think you've got to have a big picture chart that kind of directs your trading. Are you bullish or are you bearish the market? I believe we are in a secular bull market. We broke out of this secular bear market back in 2013, and these secular bull markets tend to last a couple of decades. Throughout the entire 1980s and 1990s, we had a secular bull market. Throughout the 1950s and 1960s, we had a secular bull market. So we're only in like year 7 or 8 of this secular bull market. I think we have another 10 to 12 years to go, to be honest. So I think we could be into the 2030s. That doesn't mean we're not going to have pullbacks. We had the 1987 crash within a secular bull market. We had 4 recessions during this secular bull market, 50s and 60s. We just had the pandemic in a secular bull market. Trade war. We're going to have things that come up and we're going to pull back, but they're not going to last, in my opinion. If we can come roaring right back out of these trade war drops and the pandemic drop of 35% in 3 or 4 weeks, the market can weather just about anything. I believe we're going higher. Secular bull market average return so far is about 11.88%, so below 12%. The last secular bull market, the average annual return was 15.4%, and the one before that was 11.28%. 11.88%, a lot of folks look at this and they say, we've gone too far, too fast. I don't believe that at all. I don't think we've gone that fast at all. And in fact, I wouldn't be surprised if the next year is much better than that 11.88%. I would think over the next year we might see 20 to 25% return. It's my opinion. Why? Well, let me show you a couple charts. First chart I'm going to show you is the S&P 500 here on the top and the transports on the bottom. As you look at this chart, as transports go, the S&P 500 goes. When the transports struggle, the S&P 500 struggles. It's pretty amazing. And down here at the bottom, you can see the correlation. The S&P and the transports tend to go together. Right now, we are right up against a key area of resistance on the transports. If we can get up another 3% or so, we'll make a breakout. And that breakout, in my opinion, will lead to more gains in the fourth quarter. Next chart I'll show you, consumer discretionary versus consumer staples. Look at the breakout here. When we had this sideways consolidation back in 2011, 2012, when consumer discretionary finally got the upper hand versus consumer staples and broke out in 2013, it started one of the biggest runs in the S&P 500. And looking at that ratio, consumer discretionary versus consumer staples, and looking at the correlation of that ratio versus the S&P 500, it's almost always positive. When consumer discretionary is being chosen over consumer staples as an investment alternative, the stock market goes higher. Look at what just happened. XLY, XLP just broke out. That breakout, in my opinion, leads to higher prices in the S&P 500. All right, let's take a look. Got to keep moving here. Earnings spotlight. So we still got a few more minutes. Let me pull up a couple charts here. The first one is Pepsi. Pepsi reports in the morning. Probably by the time you're hearing this recording, they will have already reported. As I look at the chart, I see a mixed signal. First of all, soft drink index versus the S&P 500 has been weak. This is not where Wall Street's putting its money. That tells me you want to be careful with the space. Pepsi, relative to soft drinks, also trending lower, with the exception of just these last couple of weeks. That makes me a little nervous. The one positive is that I see accumulation distribution up near a 52-week high. But until we can get above about 144, and until we start to see relative strength, both in terms of Pepsi versus soft drinks and soft drinks versus the S&P 500, I would stay away. So this earnings report is going to be interesting. It's not one that I would be overly bullish in terms of anticipating it, but at least the accumulation distribution looks good. The other earnings report that I wanted to show you or talk about was Bed Bath & Beyond. This is one of the most heavily shorted stocks in the market, and we've had a recent breakout with increasing volume. So I think we've got a somewhat of a short squeeze going on here, but earnings can be a crippler. So I think you got to be careful heading into earnings. I think we could pull back $1 or $2 with its earnings report, unless that earnings report is a blowout. So I'd be a little careful. But I do think anything back down close to $13, if Bed Bath & Beyond beats top line and bottom line, if they were to pull back after earnings back to about 13 and a quarter, I think that would be a pretty interesting area for entry. And if it goes higher after earnings, there are probably a lot of shorts that are going to be squirming and having to hit the exits. So this is one I think could perform well. It's actually at about a 7-month high relative to its specialty retail peers. And specialty retail has been a good group in the market. So if Bed Bath & Beyond can come up with a good report, this is a stock that certainly could go higher based on all of that short interest that's out there. All right, let's move on to the 3 you must see to wrap up the show. And I'm going to start with C.H. Robinson. This is a trucker. And if you look at the truckers, they have been pulling back since the beginning of September. So the month of September was not a good one for the trucking group. And we saw transports pull back as a result. We were above 1150 in early September. We came back down, finished at 1069. That's a lot more than the pullback we saw in the S&P 500. And you can see that down here at the bottom, truckers versus the S&P. But C.H. Robinson, relative to the trucking index, is going through the roof, or maybe through the cab. But you can see here, it took out the high from several months ago on a relative basis. It also is outperforming the S&P 500 throughout September, even though truckers are underperforming throughout much of September. So I think you have a leader here. I think on the recent high back in mid-September, we had a new AD high, accumulation distribution. We failed on Wednesday to get the breakout. We were trying to break out, we reversed. So I think in the short term, maybe we have a little bit of weakness, but this is one of the leaders in truckers. And if we get going, I think this is a stock that certainly could perform better. Next up, FCEL, Fuel Cell Energy. Stock was down 16% on Wednesday, but most of renewable energy has been doing better. I just wanted to point out that fuel cells near a support level. I don't like this relative weakness, but if the stock is going to reverse, this is the level. 210 to 220, pretty good area of support. We closed at 214. Last stock, LRN. I just want to point out what goes up must come down. Well, can come down anyway. And with K12 Inc., LRN, that's exactly what we've seen. Big move up, big move down, all the way back to where we broke out from. Anyhow, that's it for me today. Everybody have a great Thursday. I'll be back next week with more Trading Places Live. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.